Welcome to another edition of the Escala CIO Asset Allocation Research. I'm joined by Escala CIO Giselle Roux. Welcome, Giselle.
Stuart.
A couple of tough questions for you this morning, if you don't mind. Interested to know what you see as the main changes in the asset allocation piece that you've just released.
We did in April anticipate that there would by now be an improvement in economic conditions. If anything, they have deteriorated further, as is evident in the PMI, the Purchasing Manufacturing Index, which we often refer to in our publications. Aligned with that, therefore, we have reduced our expected return in most of the asset classes. In equities, just dialed them down a little bit, but most pertinently in fixed income, we have, of course, pulled back anything in the cash line of investment assets, and also in hybrids, given they had rallied very strongly, that the expected return is now likely to be significantly less than before.
So given the global rally that's taken part basically across the board, where do you see better value appearing now?
Well, this is always the question of will value emerge? In other words, sectors which show good value may not necessarily prove to be the best investments, and that what are considered to be expensive assets sometimes can rally strongly. So, for example, we've seen the US market, which everybody's been saying for some time is quite expensive. It has continued to perform relatively well, whereas those markets with attractive valuation metrics have not necessarily caught up with that. But in strict valuation terms, the UK is actually the best value market, and for those with an appetite for risk, we're not averse to the idea of a small exposure there. Japan still screens as good value, but perhaps more importantly on a sectorial basis rather than a regional basis, there are some sectors like financials, with dividend yields across the globe close to 5%, which are regaining some appetite for risk as people assume that this interest rate environment will remain low while corporate borrowing remains respectable.
Globally, with bonds trading at record low yields and in some places negative yields, they still got a role to play in asset allocation and portfolio construction?
That was proven very much in the past 12 months. We saw the very sharp rally in bonds in the December when we had the sell-off in equities, and then as the economic momentum has faded, bond yields have continued to come in, and it has been actually one of the strongest years for bond market performance. Naturally, that begs the question how much further it can go. Negative rates imply it could go a lot further. We see their role currently as really a pure insurance play against some risk-off event, but it does mean that there's space for them in portfolios, particularly those where in other parts of fixed income there has been a reach for riskier assets in terms of income yield.
Okay, so with the bull market now approaching the longest in history, and may well be the longest in history, are there any signposts that we need to be watching as we move forward?
Well, we can debate whether it has been the longest bull market, but we'll put that aside. That is data. We very much of the view, listening to many counterparties, that there isn't a call-out signal. Even the bears can't necessarily point to something that is about to give, which suggests that this kind of ongoing up and down and degrees of volatility in a low growth environment could well persist for some time. The risks are quite well known. The most obvious one would be the trade disputes, that something untoward or alternatively a resolution arises, so both are possible. And the other one that we need to be always mindful of is that liquidity in fixed income markets is not what it used to be. Banks aren't allowed to participate to the extent that they used to in the past, and that if there were to be, if you like, a rush for the door, there is a significant potential that there will be gapping in those markets, and that will play its way through into other sectors of the financial market. But to date, both of those, while troubling, don't seem to suggest that they're about to emerge as an overwhelming concern.
Thanks, Giselle. That's a great summary of what the recently released asset allocation piece is covering. As always, please talk to your advisor and discuss where you're positioned in the current environment. Thanks for joining us.